Impact: expected 50% rise in foreign direct investment in U.S. startups by end of 2026. Date: January 24, 2025. Overview. The landscape of foreign direct investment (FDI) in U.S. startups is poised for significant transformation, with projections indicating a remarkable 50% increase by the end of 2026. This anticipated growth is attributed to several factors, primarily the evolving dynamics within key industry sectors such as technology, healthcare, and renewable energy. This report synthesizes insights from various sources, including the U.S. Bureau of Economic Analysis (BA) and J.P. Morgan's Market Outlook, to provide a comprehensive analysis of this trend. Current trends in foreign direct investment. The U.S. Bureau of Economic Analysis recently reported that the cumulative level of U.S. direct investment abroad reached $6.68 trillion by the end of 2023, marking an increase of $364 billion. This trend is mirrored in the rise of foreign direct investment in the U.S., which climbed to $5.39 trillion, an increase of $227 billion. Notably, the manufacturing sector saw a significant uptick, with investments growing by $58.6 billion to a total of $2.22 trillion, reflecting heightened interest from foreign investors. According to J.P. Morgan's Market Outlook for 2025, the economic environment is fraught with geopolitical uncertainties and macroeconomic fluctuations that could influence investment flows. These factors are crucial as they shape investor confidence, particularly in U.S. startups, which have increasingly become attractive targets for foreign investments. Key sectors driving FDI growth. 1. Technology sector. The technology industry stands out as a primary driver of expected FDI growth. With its inherent potential for innovation and scalability, this sector has become a focal point for foreign investors seeking to capitalize on new and evolving markets. The rapid advancements in artificial intelligence, machine learning, and digital transformation initiatives further augment this sector's appeal. 2. Healthcare sector. The healthcare industry, particularly in biotechnology and pharmaceuticals, presents substantial investment opportunities. The ongoing advancements in medical technologies, coupled with a growing demand for healthcare solutions, position this sector as a lucrative area for foreign investment. Investors are particularly drawn to startups that are pioneering breakthroughs in treatments and healthcare delivery models. 3. Renewable energy sector. As the global community pivots towards sustainability, the renewable energy sector is witnessing a surge in interest. This shift is driven by significant policy changes and investment trends favoring clean energy solutions. The U.S. government's commitment to reducing carbon emissions and promoting renewable sources of energy aligns well with the strategic interests of foreign investors looking to participate in this transformative sector. Factors influencing competitiveness. A common theme among the analyzed sources is the recognition of the increasing competitiveness of U.S. startups. This competitiveness is bolstered by several factors. Favorable regulatory environment. A supportive regulatory framework encourages innovation and investment, making the U.S. a favorable destination for foreign investors. Strong entrepreneurial ecosystem. The U.S. boasts a vibrant entrepreneurial ecosystem characterized by robust support networks, access to venture capital, and a culture that fosters innovation. Access to capital. U.S. startups benefit from a diverse range of funding sources, including venture capital, angel investors, and public markets, which enhances their attractiveness to foreign investors. Risks and challenges. Despite the promising outlook, there are potential risks that could hinder investment growth. Regulatory challenges, market saturation, and geopolitical tensions pose significant threats to the pace of FDI increases. Investors must remain vigilant and adaptable to navigate these complexities as they consider their investment strategies. Long-term trends and economic recovery. The projected increase in FDI is part of a broader trend that has been developing over several years, resulting in notable gains observed in 2023. This growth trajectory aligns with the ongoing economic recovery efforts in the aftermath of the COVID-19 pandemic as well as the digital transformation sweeping across various industries. Conclusion. In summary, the anticipated 50% rise in foreign direct investment in U.S. startups by 2026 underscores a robust economic outlook, particularly within the technology, healthcare, and renewable energy sectors. While the potential for growth is significant, investors must remain cognizant of the geopolitical and economic challenges that could influence their decisions. The U.S. startup ecosystem continues to evolve, presenting both opportunities and risks as it navigates the complexities of the global investment landscape. The analysis of the expected 50% rise in foreign direct investment (FDI) in U.S. startups by the end of 2026 presents several counterintuitive insights. These insights challenge conventional wisdom regarding investment flows, particularly in the context of geopolitical uncertainties, regulatory environments, and the evolving nature of key industry sectors. 1. Investment. Despite geopolitical challenges, it might seem logical that rising geopolitical tensions and macroeconomic volatility would deter foreign investors. However, the analysis indicates that U.S. startups are becoming increasingly attractive to foreign investors even within this uncertain landscape. The expectation of a significant rise in FDI suggests that investors may be looking for stability and growth potential in the U.S. market, which might be perceived as a safer bet compared to emerging markets that are often more volatile. This counterintuitive trend highlights the resilience of the U.S. startup ecosystem in attracting foreign capital despite external pressures. 2. Regulatory environment as a double-edged sword. While one might anticipate that a complex regulatory environment could deter investment, the analysis suggests that the U.S. regulatory framework may actually enhance competitiveness for startups. A favorable regulatory environment can attract foreign investors who are looking for clear guidelines and protections. This notion counters the belief that heavy regulation is inherently bad for investment. Rather, it can signify a mature market that is ready for serious investment. 3. Manufacturing sector attraction. The significant increase in foreign direct investment in the manufacturing sector, which rose by $58.6 billion to a total of $2.22 trillion, is surprising given the narrative that manufacturing jobs are declining in the U.S. instead of a diminished interest in U.S. manufacturing. Foreign investors are recognizing opportunities within advanced manufacturing technologies and innovations. This counters the expectation that manufacturing would lose its appeal in favor of tech and services. 4. Emerging markets versus U.S. startups. Conventional wisdom may suggest that investors would favor emerging markets for higher returns due to lower costs and untapped potential. However, the analysis shows that U.S. startups, particularly in technology, healthcare, and renewable energy, are becoming preferred targets for foreign investment. This is particularly counterintuitive since the high valuations and competitive nature of U.S. startups might deter investment, yet the innovative landscape appears to outweigh these concerns for many foreign investors. 5. Sustainability as a growth driver. The expectation that the renewable energy sector will drive FDI growth may challenge traditional views on energy investment. While fossil fuel industries have historically attracted significant investment, the shift towards sustainable practices reflects a broader global trend that emphasizes environmental responsibility. The attractiveness of renewable energy startups contrasts with the idea that investment flows would primarily favor established industries, indicating a transformative shift in investor priorities. 6. Long-term trends amid short-term volatility. The projected increase in FDI reflects a long-term growth trend rather than a response to immediate economic conditions. This suggests that investors are looking beyond short-term fluctuations and are willing to commit capital based on anticipated growth in specific sectors. This counterintuitive perspective indicates a strategic shift in investment behavior, focusing on long-term value rather than short-term gains. 7. Healthcare investment. Despite risks, the healthcare sector, especially in biotechnology and pharmaceuticals, is poised for significant investment growth. Counterintuitively, one might assume that the high regulatory barriers and risks associated with drug development would deter investment. However, the potential for groundbreaking advancements and lucrative returns in this sector is compelling enough to attract substantial foreign investment, highlighting a willingness to engage with high-risk opportunities for potentially high rewards. 8. Digital transformation as a catalyst. The ongoing digital transformation across industries is expected to boost FDI in U.S. startups, which may seem counterintuitive in a world where digital tools and platforms are widely accessible. The notion that digitalization will create new investment opportunities suggests that investors recognize the unique value propositions that U.S. startups offer, potentially driven by superior technology and innovation capabilities. This challenges the assumption that digital tools alone equal opportunity. Rather, it underscores the critical role of innovation and talent in attracting investment. In conclusion, the anticipated 50% rise in FDI in U.S. startups by 2026 reveals several counterintuitive insights regarding investment behavior, regulatory impacts, sector attractiveness, and the resilience of the U.S. economic landscape. These insights challenge prevailing assumptions and highlight the complexities of global investment dynamics in a rapidly evolving market. In the report regarding the expected 50% rise in foreign direct investment FDI in U.S. startups by the end of 2026, several critical elements stand out that may be easily overlooked by readers. Understanding these nuances is essential to grasp the broader implications of this anticipated growth. Below are the significant points that deserve attention along with their relevance. 1. Sector-specific growth dynamics. While the report highlights technology, healthcare, and renewable energy as key sectors for FDI growth, the specific drivers within these sectors are often underexplored. Significance: each of these sectors has unique characteristics that make them attractive for foreign investments. For instance, the technology sector's rapid innovation cycles and scalability prospects attract venture capital from abroad. In healthcare, it's the advancements in biotechnology that are creating opportunities for investment, particularly as the global population ages and demand for medical advancements grows. Renewable energy is being propelled by international agreements on climate change, making this sector not just a domestic but a global priority. Recognizing these specific drivers can help investors and stakeholders better strategize their entry and participation in these markets. 2. Geopolitical and macroeconomic factors. The report mentions geopolitical uncertainties and macroeconomic volatility as potential impacts on investment flows, yet it does not delve deeply into how these factors specifically affect investor confidence. Significance: investors need to understand that geopolitical tensions can lead to fluctuations in currency, trade barriers, and changes in regulatory environments, all of which may deter or encourage FDI. For example, tensions between the US and China have caused many foreign investors to reassess their strategies in the technology sector. Furthermore, macroeconomic indicators, such as inflation rates and employment levels, can signal the overall economic health of a region, influencing investment decisions. A nuanced understanding of these factors is crucial for foreign investors to mitigate risks and maximize potential returns. 3. Regulatory environment. A favorable regulatory landscape is cited as a strength for U.S. startups, but potential regulatory challenges are also mentioned. However, the specifics of these challenges are not elaborated upon. Significance: the U.S. regulatory environment, while generally supportive of innovation, is also subject to changes that can impact foreign investments. For instance, potential changes in taxation, labor laws, or data privacy regulations could affect the attractiveness of investments. By understanding the regulatory landscape's intricacies, foreign investors can better navigate the complexities of entering the U.S. market and prepare for potential hurdles. 4. Access to capital. The report notes that U.S. startups benefit from strong access to capital. Yet it does not detail how this capital is sourced or the implications of this for FDI. Significance: The concentration of venture capital in certain regions like Silicon Valley demonstrates a disparity in capital access that could influence where foreign investors choose to allocate their resources. Understanding where capital is flowing within the U.S. can help foreign investors identify not only where the hottest startups are located but also where they might face competition from domestic investors. This knowledge can guide strategic partnerships or acquisitions. 5. Market saturation risks. While the report mentions potential market saturation as a risk, it does not explore which specific markets may be nearing saturation and how this could impact future investments. Significance: awareness of market saturation in certain industries can inform investment strategies. Investors may find that while a sector like fintech appears lucrative, it could also be saturated with competition, making it harder for new entrants to succeed. Identifying emerging niches within these industries or exploring less crowded sectors could yield better investment opportunities. 6. Long-term trends post-pandemic. The report relates the projected FDI increase to post-pandemic economic recovery but does not fully articulate the long-term trends that may be reshaping the investment landscape. Significance: the pandemic has accelerated digital transformation across various sectors, creating new business models and opportunities. For example, remote work has spurred investments in cybersecurity and cloud services. Understanding these long-term shifts can help investors align their strategies with future market realities rather than just focusing on current trends. 7. Impact of emerging markets. Although the report briefly mentions emerging markets, it does not explore the implications of U.S. startups becoming attractive targets for foreign investments from these markets. Significance: as emerging markets continue to grow economically, they may start looking outward for investment opportunities. This could lead to increased competition among foreign investors in the U.S. startup scene, potentially inflating valuations and altering the dynamics of investment. Additionally, understanding the motivations of investors from emerging markets can offer insights into future trends and the types of innovations they may favor. Conclusion: the anticipated rise in FDI in U.S. startups is a crucial development with various layers of complexity. By focusing on the overlooked elements such as sector-specific dynamics, geopolitical influences, regulatory challenges, access to capital market saturation, post-pandemic trends, and the role of emerging markets, stakeholders can better navigate this evolving investment landscape. This nuanced understanding is vital for both domestic and foreign investors looking to capitalize on the projected growth and mitigate associated risks. 1. Projected 50% rise in foreign direct investment (FDI). The anticipated significant increase in FDI by 50% in U.S. startups by the end of 2026 marks a crucial turning point for the U.S. economy. This growth is reflective of broader economic recovery efforts post-pandemic and highlights the resilience and attractiveness of U.S. startups to foreign investors. It underscores the importance of understanding the dynamics of global investment flows and how they are shaped by various economic and geopolitical factors. 2. Key industry sectors driving growth. The expected surge in FDI is primarily concentrated in 3 key sectors: technology, healthcare, and renewable energy. The technology sector is particularly appealing due to its innovative potential, enabling scalability and growth, while the healthcare sector is being driven by advancements in biotechnology and pharmaceuticals. Renewable energy is gaining momentum in light of global sustainability trends. Analyzing these sectors provides insights into where investor interests lie and the potential for future economic development. 3. Impact of geopolitical and economic factors. The reports from J.P. Morgan emphasized the critical role of geopolitical uncertainties and macroeconomic volatility in shaping investment flows into U.S. startups. The investor sentiment is influenced by these factors, particularly in the context of emerging markets where U.S. startups are becoming increasingly attractive. Understanding these risks and their implications for investment strategies is essential for foreign investors aiming to navigate the complexities of the current investment landscape. For competitiveness of U.S. startups, U.S. startups are noted for their increased competitiveness bolstered by a favorable regulatory environment, strong entrepreneurial ecosystem, and access to capital. However, potential risks exist, including regulatory challenges and market saturation. An in-depth discussion on the factors contributing to this competitiveness and the risks involved will provide a comprehensive understanding of the landscape in which foreign investors will operate, highlighting both opportunities and challenges. These 4 points are integral to understanding the broader implications of the expected rise in FDI in U.S. startups, covering economic projections, industry sector dynamics, external influences, and the competitive environment. 1. The dot-com bubble 1995 to 2001. The late 1990s saw a meteoric rise in foreign direct investment in U.S. technology startups driven by the burgeoning internet and technology sectors. Investors poured capital into companies with online business models, leading to inflated valuations and a speculative bubble. This influx of investment was characterized by significant amounts of venture capital, resulting in the rapid growth and subsequent collapse of numerous dot-com companies by the early 2000s. The aftermath of the bubble burst led to increased scrutiny of investment practices and a re-evaluation of the tech industry's business models, ultimately shaping the modern venture capital landscape. 2. The rise of foreign investment in U.S. manufacturing 1960s to 1980s. During the post-World War II era, particularly in the 1960s and 1970s, foreign direct investment in U.S. manufacturing significantly increased. Countries like Japan and Germany invested heavily in U.S. factories and production facilities, driven by the desire to access the American market and benefit from its advanced infrastructure. This period saw the establishment of numerous joint ventures and subsidiaries, which not only bolstered the U.S. economy but also transformed the manufacturing landscape, leading to increased competition and innovation within the sector. 3. The global financial crisis and FDI recovery 2008 to 2015. The global financial crisis of 2008 severely impacted foreign direct investment flows worldwide, including in the U.S. However, following the crisis, there was a substantial recovery in FDI, particularly in sectors such as technology and healthcare. Investors recognized the U.S. as a stable and attractive market for growth, leading to a resurgence in investments in startups and established companies alike. This recovery phase was marked by a focus on innovation and the emergence of new technologies, setting the stage for future investment trends in the subsequent years. The future outlook for foreign direct investment (FDI) in U.S. startups indicates a significant growth trajectory, with expectations of a 50% increase by the end of 2026. This forecast is driven by 3 key industry sectors: technology, healthcare, and renewable energy, which are poised to attract substantial foreign investment. 1. Technology sector. The technology sector is expected to lead the charge in FDI growth. As the U.S. continues to be a global leader in innovation, foreign investors are increasingly looking to capitalize on emerging technologies such as artificial intelligence, cloud computing, and cybersecurity. The scalability of startups in these areas presents an attractive opportunity for international investors seeking high returns. The competitive landscape is further enhanced by a strong entrepreneurial ecosystem in the U.S., supported by venture capital and a favorable regulatory environment that encourages innovation. 2. Healthcare sector. Advancements in healthcare, particularly in biotechnology and pharmaceuticals, are creating significant investment opportunities. The COVID-19 pandemic has accelerated the focus on healthcare innovation, leading to increased funding in areas such as telehealth, personalized medicine, and vaccine development. As the global population ages and health concerns rise, the demand for innovative healthcare solutions is expected to grow, making this sector an appealing target for foreign direct investment. 3. Renewable energy sector. The renewable energy sector is gaining momentum as the world shifts towards sustainability. U.S. startups involved in renewable technologies such as solar, wind, and battery storage are attracting foreign investment due to supportive government policies and a growing commitment to reducing carbon footprints. As countries worldwide implement stricter environmental regulations and seek to transition to cleaner energy sources, the U.S. renewable energy market is positioned to benefit from increased foreign participation. Economic and geopolitical context. The backdrop for this anticipated rise in FDI includes a recovering U.S. economy and a growing emphasis on digital transformation across industries. The U.S. Bureau of Economic Analysis reported a significant increase in both U.S. direct investment abroad and foreign investment in the U.S., indicating a robust investment climate. However, the landscape is not without challenges. Geopolitical uncertainties and macroeconomic volatility, as highlighted in J.P. Morgan's market outlook for 2025, could impact investor sentiment and market dynamics. Investors must remain cautious of potential regulatory challenges, market saturation, and the evolving global economic landscape that could influence their strategies. Conclusion. In summary, the outlook for foreign direct investment in U.S. startups appears promising, particularly within the technology, healthcare, and renewable energy sectors. The anticipated 50% rise in FDI by 2026 reflects a strong economic recovery and a favorable investment climate. However, stakeholders must navigate the complexities of geopolitical and macroeconomic factors that could shape the investment landscape in the coming years. With the right strategies and insights, investors can harness the growth potential in these key sectors, contributing to the overall dynamism of the U.S. economy.